Hello, good morning, good afternoon, good evening, depending on which part of the globe you're at. This is the FNA's Payment System Broadcast, session 26. Welcome, everyone. We're going to start in a couple of seconds. We're going to allow people to join. Thank you for being here.
Our pleasure.
Thanks for having me.
Good. So in the meantime, I'm going to let you know how this type of broadcast works. So usually we have 5 minutes for introduction and housekeeping. I'm going to do that in the next 5 minutes, as I said. Then we're going to have the main session, which is expected to last at least 45 minutes, in which we're going to have our prime guests, Dirk Bulmann, Managing Director of Public Policy Strategy and Innovation at the CEO Office of CLS, and Keith Baer, which is a fellow at the Cambridge Center for Alternative Finance. As I mentioned, we're going to have a very lively, interesting conversation lasting more or less 45 minutes. And at the end of the session, we expect to have a 10-minute period in which we're going to have Q&As from the public. For the public, please use the widget that is included in the WebEx app, which is called Slido, in which you can formulate your questions, and we're going to try to answer all of them or most of them. So once again, this is Payment System Broadcast number 26, in which we have Dirk Bulmann and Keith Baer. Thank you, Dirk and Keith, for being with us today. Just to start, do you have any disclaimers that we should share now before we start?
I guess my comments are my own rather than the University of Cambridge's for me.
No, nothing on my side. Thank you.
Good. So the title of today's broadcast is very provocative, which is the myths in post-trade wholesale FX. What we intend from this broadcast is, and we started doing this a few months ago already, is to bring some light into several terms and several conceptions about how post-trade wholesale occurs in FX markets. So the idea for today is to have a very timely discussion on some of those most persistent myths in what happens in post-trade wholesale FX. So the idea is to debate a little bit about, for instance, DLT technology, settlement models, and how the evolution of the post-trade infrastructure is expected to happen. So that's the whole point of our conversation today. So let's start, and it's always good to have the terms very clear. So let's start with definitions. The first one, a common claim is that atomic settlement and instant settlement are the same thing. So let's start with you, Dirk. Could you explain the difference and why this misunderstanding persists?
Thanks, Carlos, and hello, everyone. Thanks for having me on this podcast. You asked for a disclaimer. I don't have a disclaimer, but maybe I come across as a skeptic in this podcast, just to, at least try to reassure people I'm not. Change is the law of life, so we all need to embrace change. But it's just there was a lot of discussion on around terminology in particular, where things appear to be novel, which when you look a bit more under the hood, maybe they are not. And I think the atomic settlement is a point in question here. So because when you try to understand what does it mean, atomic, it derives from the Greek word atomos, which means uncuttable, and the term atomic emerged in 2013, I think it was, more than 10 years ago, in the context of atomic swaps, where there was the idea of having cross-ledger cryptocurrency exchanged. And these exchanges can have two states. Either they happen or they don't happen. So atomic. And then later on, experimentation around blockchain started. And it's great to be here with you, Keith, because we were part, I think it was back in 2017, 18, I think we worked together in different roles on precisely this question around whether settlement payment exchanges could work on a blockchain. And so then the term atomic settlement was born in this context. And the idea was to speak, it was simultaneous exchange of assets still across ledgers. But over time, things have changed. So what started with a cross-ledger simultaneous exchange then was broadened. Then people discussed also atomic settlement if they speak about a single ledger, not only about cross-ledger exchanges. And then because many experiments are about instant settlement, they also said, okay, then atomic also means instantaneous. So that means you need to be very careful when you speak about atomic, because it can mean different things to different people. The narrow description is it's simultaneous across ledgers, and it could also, in the broader context, mean it's simultaneous, it's instantaneous, can be cross-ledger or single ledger. I hope I didn't lose the audience with my introductory remarks here on terminology.
No, in fact, that makes everything clearer. So the original term is about simultaneous across-ledger settlement, which is at the end the whole point of atomicity. The instantaneousness is something different or additional, if we can say that. Keith, where does DLT, distributed ledger technology, genuinely add something new here?
Sure. I mean, I think it adds potentially a lot of value in new areas. So it delivers benefits, obviously, in particular when the asset leg is already tokenized. So I appreciate that's not quite so relevant in the PVP FX kind of context. But if we're talking about bond settlement or other kinds of assets that are already tokenized, then clearly the ability of the technology to provide atomic and simultaneous settlement potentially is an advantage, depending on the exact use case, because obviously there's a whole set of consequences of that I'm sure get into. So obviously we're seeing financial markets adopting asset tokenization at speed at the moment in the number of bond issuances, the digit bond issuance in the UK that's upcoming, for instance, tokenization of real estate, private credit, etc. There's a continuing theme of that, which is putting pressure, I think, on central banks to provide wholesale CBDC capabilities to provide that facility for atomic settlement, all on a digital ledgers, be they two ledgers, one for the cash leg, one for the asset leg, and some sort of synchronization mechanism in between. Or more likely, in terms of what the future direction is, having a single ledger, as Dirk touched on, which provides that true atomicity and potential simultaneous settlement as well. So I think some of this is certainly being driven from the asset tokenization side. And I think the question that kind of leads to is what the implication is going to be on the FX business, on the PVP business, when there are more countries that are more central banks that are making wholesale CBDC available. And what does that mean in practice for this whole question of FX settlement?
That's great. So we already have some clarity about atomicity and how does DLT allows or makes everything easier in that sense. Let's go to the next one, which has to do with how does affect atomicity, or not atomicity in this time, but real-time settlement. So we're not going to talk about speed. How does speed affect liquidity demands? So this is a common claim that it's always that it has been like discussed, and we in previous broadcasts we had some people attending and making questions or comments about how instant settlement or real-time settlement could improve the efficiency and liquidity recycling. And someone from CLS, Emmanuel, shared his thoughts about how the real-time or the instant settlement could affect liquidity recycling. Keith, could you unpack why instant settlements may actually increase liquidity demands, which is the crux of the thing?
Sure. So instant settlement means that netting is no longer possible, obviously. So the settlement effectively is taking place on a gross basis. And that obviously means that the positions on either side of a transaction need to be pre-funded in that respect. And that pre-funding activity obviously means that there could be less liquidity in the market from that point of view, because those positions need to be pre-funded in that context. And Dirk, obviously, and CLS, have very large netting benefits that they bring in the FX market. So not having those available in this kind of context is obviously has a significant impact on liquidity. So I think it's it's a trade-off. Instantaneous settlement may be appropriate for certain kind of use cases, certain types of assets which are taking place. On other markets, it's not so practical because of the loss of the benefits of netting in that respect. So I'll leave it there because I'm sure Dirk's got comments as well.
I'm going to make a comment, but I think that I should allow Dirk to go first. Then I'll make mine. Dirk.
Yeah, thank you. I can only echo what Keith said, but actually, market participants, market players have a choice. No, they can do T+2 settlement, they can do T+1, they can do same day, they can do instant. The question is just, is there a use case in the wholesale space? If you think, for example, a classic use case is international trade. Normally, these are flows which are well orchestrated and planned and in advance. And normally, you don't need an instant payment because you know exactly when you arrive, when the goods arrive, and then you need to make the payment. So this is you have this planned and organized. So is there a use case in the wholesale space? Of course, if you at the end of the day maybe need to square some positions, fine. Maybe you need to rely on instant. That could be a possibility. But as Keith alluded to, in the wholesale FX space, which I would say is the far end of wholesale, because there are large amounts at play. So CLS, we are the settlement backbone of the FX ecosystem, and we settle on average. There's a lot of volatility in the market these days, and so volumes and values are growing as we speak. Between 7 and 8 trillion US dollar equivalent are exchanged in terms of value every day. This is twice the annual GDP of the UK. What we process on a single day. So these are enormous amounts. And if you are a market participant and you want to do business, then you need liquidity optimization. And it's interesting. We are there. CLS is there because the public sector in the 90s already said we need to mitigate FX settlement risk. This is what we do. But then the market players said, of course, this is important. The public sector is absolutely right. But what we also need is liquidity optimization. And that's what we offer. And our liquidity optimization goes as far as 99%. That means only 1% of the needs to be funded of all the traffic that goes through our system. And the market needs that. So is instant a possibility? Yes. Is it a good use case? Today, maybe not. Maybe tomorrow, we will see.
That's great, Dirk and Keith. I think that, and going back to the time that we had another broadcast with CLS in which we discussed this topic for a few minutes. The thing is that, as Dirk and Keith already mentioned, netting is a bliss. Netting is fantastic for financial markets because, as already Dirk mentioned, you only need about 1% of the value to be settled in the as the balance in the accounts for financial institutions to be settling these amounts. So this is about how efficient the FX market is. You only need 1% to settle the entire market. I mean, to clear all the market, and that's clear efficiency. The thing that there is in which we call this a misconception is that there is some alternative, let's call it theories about if you settle everything like in the, increasingly fast, everyone is going to start receiving and paying as fast as possible, as quick as possible, and then everyone is going to be able to recycle liquidity. But that, according to at least our calculations at FNA, and we work a lot on simulating this kind of models of settlement, that is not the case. I mean, netting, having netting opportunities, even if it's, in the extreme, once per day is the best DNS, or the deferred net settlement at the end of the day is the best case of liquidity efficiency. But if you start having several of these cycles during the day, that's also very efficient. It can be very efficient, or resequencing the payments. And what we have in the other side of the spectrum is if we have like instantaneous settlement or of the payments, that's not efficient. It will require the participants to have a lot of liquidity. So that's the second myth that we're dealing with here. Let's go to the next one. Some argue that DLT could uniquely enable atomicity across multiple ledgers, FX payment versus payment, securities delivery versus payments, and collateral transfers all synchronized in just one single transaction. Dirk, is this realistic today, or is it still a theoretical thing?
Yeah, what you see today is that you need someone who is maybe in the middle between multiple ledgers, or at least governs a joint ledger, and these needs to be entities like CLS, or I don't know, CSDs or clearinghouses, or you name it. For me, and again, maybe I appear to be too skeptical. DLT is a technology, and you need to connect ledgers, and for this you need maybe standards. You also need legal frameworks beyond the technological solutions. You have great ideas out there like synchronization operators, which could play the role and link ledgers. You can also use hash time lock contracts, HLCs, for example, where you have no one really governing this. But I wonder how viable this is. But my point is again, there's a technology layer, which is one thing, but the questions remain the same, irrespective of whether you use DLT or legacy technology. You have to have interoperability, which goes beyond technology, which is as operational frameworks, legal frameworks, and so on. And this doesn't change.
That's great, Dirk. Keith, what do you see as the main barriers to achieving cross-ledger atomicity?
Good question. So we did a research report at the end of last year, and I think FNA are putting a link into that, into this call. So we basically interviewed 22 banks and central banks on their perspectives on this, coming at it from a wholesale CBDC perspective, but we looked at many of the topics that Dirk just touched on, and all the proposed approaches, etc. And that kind of breaks down, in terms of sequence in some respects to the trigger solutions or the synchronization solutions that Dirk just mentioned, such as what the Bundesbank originally piloted last year, together with the Bank of England's Meridian initiatives, for instance. And that obviously isn't what you're talking about, but provides a means of linking an asset leg, which is tokenized, with the RTGS system within the central bank to provide a level of atomic settlement. But that has questions about the synchronization itself. So, there may be latency associated with that synchronization. There may be failures of synchronization if that entity or the mechanism fails in some respect. And as Dirk touched on, certainly in the Bank of England's perspective, there needs to be some kind of new FMI construct that operates that synchronization mechanism, which kind of implies that it would be seen to be outside of the role of the central bank. So understanding how that works in practice, certainly in the UK, I think will become clearer, because, as you know, the Bank of England is launching a synchronization lab, which will explore the ways by which this could be done. But understanding who the FMI or what the FMI might be in that role, I think, is a question. And also whether the ECB will be following a different model, because this is obviously part of the Pontis first track of the dual tracks the ECB are following. So exactly how will that work in practice? Then the second approach is obviously having potentially two ledgers and some sort of linkage between both ledgers that you're talking about, as kind of illustrated by Banque de France's 3DS model, which was again part of the ECB trials, and again has a role to play as far as the Pontis track is concerned, and potentially beyond that as well. That obviously has now is just talking about pure DLT on both ledgers, but obviously still has two different ledgers that have to be interlinked in some way. And then Nirvana, arguably, is having a single ledger which has both the asset and the cash leg on it. And that essentially is what Helvetia has demonstrated with the Swiss National Bank efforts. And it was interesting hearing somebody from the Swiss National Bank talking about that, because in this context, we're probably talking about a third party operating that ledger, and the central bank having confidence that they are happy for central bank money to be tokenized on a ledger which somebody else is operating. Obviously, the whole set of control, system control and other kind of concerns about that. But that's essentially what Helvetia did. And when quizzed on that question, the speaker from SMB made the point there was a high level of trust between the central bank and SDX, or SIX, I should say, that was running that ledger because of all the close interlinkages that exist within the Swiss financial market infrastructure that SIX provides already. So trust and controls really are the big barrier, I think, to get over for central banks to understand how the linkage point cross-ledger into atomicity can be further advanced by not even having that cross-ledger, but just having a single ledger in that respect. So how we actually move from where we are today with this kind of model of synchronization in the short term through two ledgers and the interlinking between those to the nirvana of a single ledger, which is operated by a third party. Obviously, that's quite a complex and challenging progression, both from the central bank's point of view as well as from market participants' perspective, who are obviously looking for as much efficiency and lower cost and having the right approach to liquidity, etc., as possible. So interesting times, I think, as far as that migration is concerned.
Trust and that's great, Keith and Dirk. Trust and control regarding one single layer to have it all spells or reminds everyone about resiliency, because if we're trusting just one single layer to do everything, that means that we have like a single point of failure risk just ahead. So let's jump to the topic that is related to resiliency. So Keith, is decentralization a synonym for resilience in settlement systems? Is that the case?
Sort of yes and no, or probably more no than yes, I think. Because obviously, in principle, at least, decentralized architectures, as you rightly say, do get rid of some of the single points of failures, at least within the kind of blockchain architecture in that respect. But of course, there can be other points of failure that exist, new points of failure that exist in that respect. At multiple levels. I mean, we've obviously just seen a major AWS outage, for instance. So if there were nodes that were primarily being run on AWS cloud, then obviously that would have a direct impact. So things like the cloud infrastructure, the infrastructure that such nodes operate on is an element which is in some respects independent of the decentralization of the DLT architecture itself. There are other kind of concerns as well, for example, on quantum exposure. So one of the research themes we have at Cambridge is looking at quantum exposure of blockchains. So for centralized entities, obviously there's a question of what level of cryptography is used and whether the cryptography is quantum resistant, etc. But when you consider public blockchains, which are used increasingly within financial markets, especially on the buy side, these have typically decentralized governance at some level. So understanding how that decentralized governance model and the developers that are part of that environment, how they're able to make the changes required to provide that quantum security. According to the analysis we did, something like 11% of the blockchain code repos, so the code repositories that blockchain technologies are using, only 11% of those were using quantum-ready cryptography. So there's quite a long way to go. So to answer your question, there are benefits, obviously, with decentralized architectures as far as resilience are concerned. But some risks like quantum and others still exist, which challenge the resilience. And then obviously the nature of DLT as well potentially provides new kind of risks as far as resilience is concerned as well. So it's an interesting topic. The Bank of England ran a workshop on the operational resilience of public chains, I think a year ago or so. So I think it's certainly got a lot of regulatory attention at the moment to understand exactly what, as more of financial markets move to public chains in particular, exactly what the impact is going to be on operation resilience.
Thank you, Keith. That reminds me of something that someone told me when I was pretty young in risk management, which is that the risk never disappeared. It's only transferred somewhere else. The point is that you're finding where it has been transferred, because that's not very clear always. And the AWS thing that recently happened is a good explanation of where the risks are. And perhaps we don't know always are aware of those. So Keith, related to this, what is the role of, Dirk, what is the role of governance in the resilience of settlement systems?
Well, governance is of our overriding importance, of course. But let me just to build on what Keith just said, that in the financial in the FMI world, financial market infrastructure, well, resilience is a key theme, and many of the systems out there are of systemic relevance. So we need strong business continuity in place. You need to ensure timely recovery of operations, and this cannot be underestimated. So really, this is a cyber resilience is one of the key themes. And when you look at the blockchain, there's always a bit the claim that because it's decentralized, it's superior maybe to traditional service because you can mirror data across nodes. But I think in the financial sector world, this is maybe not always happening or possible because of confidentiality, for confidentiality reasons. And maybe sometimes you also have central roles, like someone who has to certify the payments before they enter. So you have single points of failure. And not to forget, and I think this is one of the main arguments, it's the attack surface. If you have a decentralized setup, the attack surface is much bigger. So really have to look carefully at the claim. And again, it's myth busting here. But again, I don't want to appear overly critical, but this is something we have to bear in mind. So, and therefore we have clear rules. We have the BIS. We have the standard setting bodies. We have to have clear governance in place, and this is what we have in the existing world. But when we move to a decentralized setup, we have to really carefully make sure that the service level we have and the resilience levels, the business continuity we have in place is not in some shape or form deteriorated through the setup and design.
That's great, Dirk and Keith. Going forward, and it's related to the resilience thing, is CLS has delivered unmatched resilience through multiple financial crises and many different types of stress events. Most DLT platforms, by contrast, remain untested at a scale. Dirk, how should we compare these two worlds? I mean, is there a way for us to have like a horse race about which system is better for stress test scenarios?
Oh, I think it wouldn't be fair to say CLS or peers, CLS peers are maybe better because we operate in a different environment compared to the DLT. DLT is still used in my view and from what I see in small scale solutions and applications. And so the systemic relevance, which I mentioned a minute ago, answering your previous question, maybe it's not so much at the forefront when you have a smaller scale system, when comparing the backbone of a financial system in a jurisdiction or maybe globally. So I think it's difficult to compare, but yes, DLTs may be largely untested because it hasn't been around for a long time. Okay, it all started 2008, 2009. We all know, but actually it's a consequence of the financial crisis 2008. While we can say CLS worked and other systems worked through the financial crisis and through COVID and so on. So I think because of the different nature of the solutions that currently exist, it's really difficult to compare existing players which have having a large network and which process a lot of transactions at high volume and or high value or both to DLT solution. I just think it wouldn't be fair to make this comparison.
That's great, Dirk. Kate, what lessons can we draw from history about resilience being more than just the technology?
As I said, I think in part resilience depends on good governance. So if you take from an FMI perspective, take the kind of steps that are necessary in terms of identifying important business services, understanding and defining impact tolerances, being able to map the whole of the environment in terms of individuals, business processes, applications, infrastructure, and then doing scenario tests. That's the kind of challenges that FMIs face in terms of being compliant with regulations. those today don't typically relate to what happens on blockchain environments, or at least public blockchain environments. So I think that gives an illustration that just against those headings, whilst the technology has certain aspects here, things that sit above it in terms of the users and the applications, and things that sit below it in terms of the infrastructure that it runs on, there's a whole set of complexity and mapping that if public blockchains were to be compliant with the kind of operation resilience regulatory requirements, there would be quite a few challenges, I think, of working out how to do that in practice. So as I touched on, I think understanding the operational resilience characteristics and where the risks are as far as public chains are concerned is quite a challenge in that respect. But just to pick up again on what Dirk said, I agree that you can't easily compare, entity FMIs like CLS and the scale and history of successful operation in that respect against blockchains. But obviously, Bitcoin and Ethereum, whilst they've only been around since the last decade, still have a pretty good track record, I would suggest, in terms of continuing operation 24/7. Yes, they've had their odd hiccup, but not any significant downtime and any significant issues in operational considerations. I mean, obviously, there are things like what happened with Bitcoin Cash and so on, but these are relatively minor compared to the continuing successful operation over a decade or more. So, there are examples like that where the technology itself, and certainly in the public blockchain world, has demonstrated that those kind of models can be secure and can be resilient at the DLT level. But obviously, as I said, questions around many aspects as far as resilience are concerned, all the same.
Thank you, Keith and Dirk. Now we're entering one of the fields in which the term that Dirk reminded us about mythbusters. I started seeing in my mind this TV series of these two guys who made science or tested some myths about science or some myths about what happens in real life. So this myth is perhaps one of the most, for me, one of the ones that I encountered the most in social media, which is about how slow and outdated the traditional finance backbone is. So normally you always hear, well, if I want to send money from country A to country B, it will take 2 days and it will be cost X. It's very outdated, it's very slow. That's fault of SWIFT, that's fault of banks, that's fault of everyone and anyone. Why do these conventions like T+2 settlement cycles exist and have been convened on? And how do they serve market needs, Keith? That's perhaps the first way or the first question for us to debunk this myth.
As you say, I think current market conventions historically have needed to allow market participants to complete the operational processes that need to take place within that environment, such as trade confirmation, matching, allocation, any collateral margining that's taking place, funding of positions, and so on. So all of that can be a complex set of operational processes, happening potentially on a global basis if we're talking about cross-border activity with different instruments, be it FX or other things. So the complexity of buyers being able to arrange for cash to be available for the cash leg and sellers to have the securities or the asset side of the leg available as well. This historically has taken time, and that's kind of led us to the T+2 or whatever settlement cycle we may be in. And obviously, we've seen over the last few years, a couple of years, the effort to shorten those settlement cycles with T+1 implementation for equities in the US and what's happening within UK, EU, etc., in terms of doing similar for European markets as well. So that is kind of, in some respects, understanding where new efficiencies can be brought into play in order to be able to compress the settlement cycle and therefore get reductions in settlement risk associated with that. But that obviously kind of contrasts with what happens, as we touched earlier in the call, in terms of instantaneous settlement, where one of the benefits we didn't really talk about is just getting rid of the counterparty risk associated with that as well. So kind of a trade-off between those two things. But to answer your question, I think it comes from market convention and understanding the level of appetite that might exist in the industry to do things quite differently, as opposed to incrementally improving what we've got. And T+2 to T+1 migration is an example of the latter. But other things that are taking place in the world of stablecoins, arguably, or some of the new innovations coming down the line using DLT potentially is an example of the other aspect as well.
Thank you, Keith. And I think that I mean, your answer also highlights that something that I have believed in the last. I mean, after I have started seeing the discussion go live a couple of years ago, which is that I believe that retail payments, they want to be instantaneous for good reasons. Because if I am Carlos and I want to send money to Dirk, I want to see that happening right now. That's no counterparty risk, and there is like the immediacy. It's good for the people trying to do this. I mean, for the individuals. But in FX markets, the story is completely different. The banks, they don't care that much about having an instantaneous payment, but to have a big liquidity saving, which at the start of our conversation is, we already mentioned that that's achieved by netting. And if it's just one netting cycle at the end of the day or the start of the day, that's great, because it's going to achieve what Dirk mentioned as the CLS achievement, which is 1% of the liquidity is the only thing that is needed to settle and to clear the whole market. So I think that's like the difference of retail and wholesale at the end.
I mean, there's another example, which is large corporate treasuries, multinational corporate treasuries, where the immediacy of being able to use stablecoins in this particular case for real-time liquidity management. I mean, that's where, to slightly counter what you're saying, in that use case, the immediacy of instant settlement over using stablecoins to move money where it's needed, as opposed to having it sitting idle due to banking hours, etc. There is a benefit there as well. So I think, from summary, it depends on the use case. Are we talking about CLSs, cross-border FX flows amongst institutions, or are we talking about internal treasury, or, as you say, retail instant payments as well?
That's exactly the point. The use case may be very different to which sector of the economy you're asking this question to. That's the balance between the immediacy and the efficiency is somewhat different depending on who we ask. So Dirk, what are the risks of combining or conflating execution speed with settlement requirements?
Yeah. And again, sorry to build on. I answer the question, but build on what Keith said. I think the settlement cycle is defined by the art of the possible. Yes, now it's T+2. Next year, 2027, in Europe, it will be T+1 in the security space, and maybe little by little also the FX world will take over this rule as a convention. But just to remind, and it's interesting when you look a bit back in history, 200 years ago it was T+14, because assets had to be exchanged physically and using horses, maybe between stock exchanges. So the art of the possible matters here. This is how you define really the settlement cycle. And I think what is important is not to confuse, and this is, I think, what is happening, unfortunately, still, to confuse the settlement cycle and the actual settlement process. The settlement cycle can be T+2 or T+1. Yeah, you trade today and you settle in 1 or 2 days, business days from now. That's one thing. But the settlement process itself, as I mentioned earlier, can be this is simultaneous settlement, and this is a matter of minutes, if not seconds, to get this done. So there's a difference, and it all hinges, and you already mentioned that it's the use case, the underlying use case. Today we just don't see the use case in the retail, in the wholesale space the way we see it in the retail space. But I must say that it's interesting to observe that I don't know, 5-10 years ago there was a clear divide between user requirements for instant payment systems compared to wholesale payment systems. And now you see wholesale payment systems, they are maybe moving more towards extending operating hours, maybe even operating them over the weekend. And so the dividing line between the two becomes blurred. But we're not yet there. I think still in the wholesale space, there is still as I also answered to a previous question, there's still a clear use case for T+2, T+1, and not settling instantaneously.
That's great, and I think that there was something to keep on like this Mythbusters goal, which is that there is no technology restriction to settle in T+0. There is none. It's just a market convention to settle in T+2. And for instance, it has always been surprising for me to tell the stories about how in Colombia everything settles T+0 or almost everything, and everyone is like, "How do you do that? I mean, what is the technology behind that?" I mean, it's plain vanilla, traditional, customary technology. There's no DLT, there's nothing. I mean, it's not a matter of how you register transactions. I mean, technology allows you to have like instant settlement decades ago. So that's perhaps something that also makes part of this myth-busting task that we have today. So the next one is the last one, and we're going to have, I think, plenty of time to address some of the questions that we have received, very interesting questions that we have received in the Q&A. So the last one is, let's look ahead. So Dirk, the first question has to do with the joint work that CLS and FNA did a couple of months ago, at the start of the year, in fact, in which it was suggested by results that multiple settlement cycles per day could balance risk reduction with netting efficiency. Dirk, what benefits do you see from adding settlement cycles, and what is the trade-off here?
Yeah, so the question we ask ourselves is, and this goes back to my previous statement, maybe the wholesale world will eventually move more or closer to the instant retail, instant settlement world in the retail space. The question is, how far can you move the needle towards instant settlement without losing netting benefits, which are very important for our clients, for all stakeholders in the FX space or in the wholesale space, maybe. So that means you cannot, as also Keith mentioned earlier, if you have instant settlement, you settle gross, pre-funding, an enormous amount of liquidity is costly. No one wants that in our world, in the wholesale world. So then we thought, okay, maybe we think about a realistic scenario. Today we have one settlement cycle in CLS. We settle between 7 in the morning and noon. So let's think about having 3 settlement cycles. Why 3? Well, because there may be one for the Asian world, one for Europe, Africa, and the second one maybe for the Americas. And we understood from our stakeholders that more than 3 cycles is maybe operationally challenging. So that's what we did. So what are the benefits of that? Well, there's, our business is, and PVP is about simultaneous settlement, which means you mitigate settlement risk because everything happens, either it happens or it doesn't. That's atomic. So this is the benefit. And when there's the same day market, which we have estimated to be in the range of, I don't know, 500 billion per day, is maybe largely unprotected today and could move to the PVP space and being then protected from settlement risk. That's a big benefit. And then when you have that, you can also offer netting. That means in our scenario, we said, okay, we can, if you bring the 500 billion to our service, you do netting, you can reduce the funding needs by, let's say, 50%. This is roundabout what we. And okay, these are the benefits, but are there disadvantages? We felt at the beginning when you slice the settlement cycle into 3 and say, okay, then you fragment in a way the flow. That means you maybe also need more liquidity if you want to settle in buckets. But the surprising outcome was, yes, it's true, but the impact is marginal. The reduction in efficiency there, the netting efficiency is 1%. So when you compare the benefits to the challenges or the downsides, I think the benefits clearly outweigh the negative impact that this could have. So this was the outcome of our experiment and our joint journey with FNA. So, and we will see and discuss with our stakeholders whether this is a journey which we should embark on in the future.
Thank you, Dirk. And that's the beauty of simulation. I mean, because you can test and iterate until finding what is perhaps the desired design options of a system. So that's the whole point of it. Keith, how do you think this debate will evolve as new technologies mature?
That's a good question. I mean, as Dirk already covered, obviously there's a balance, an optimization for CLS settlement cycles in terms of risk reduction and netting efficiency, depending on the cycle frequency, etc. But imagine a future world where everything is tokenized, all assets are tokenized, all forms of digital money are tokenized. Obviously, this is probably a long way out, even if it ever happens. But potentially the way that settlement happens in that context could be quite different. In particular, maybe for those currencies which are not CLS eligible, so outside of the 18 currencies that CLS supports today. So I think we're likely to see sort of 3 phases maybe of migration. And the first phase, next 2 or 3 years, more pilots, as we just talked about in terms of what CLS may do, but others as well. What's going on with wholesale CBDC, Pontus, Appia in terms of ECB world, etc. Understanding how these new technologies and new approaches can make an incremental benefit as far as that's concerned. More in the medium term, I think we'll see more examples of hybrid models coming in. The technology will be more advanced, the acceptance and the regulatory appreciation maybe of those kind of approaches will have a more significant impact. So we're likely to see more advanced potential applications of the technology in that respect. Then, as I said, in the extreme future, if it ever happens, when the tokenization of everything happens, then I think that leads to all sorts of new possibilities we may not be able to fully contemplate yet across different asset classes, across different participants, and understanding how that creates new benefits in terms of the economics around liquidity, for instance, the regulatory treatment of those new models, who's going to bear the intraday funding cost associated with these new kind of models. So I think the technology at that stage, when we have the regulatory acceptance and we have tokenized wholesale central bank money in that context, raises quite new potential that, as I said, we can't probably fully realize yet. But I think those 3 phases give an indication of where the technology will evolve to support this kind of environment.
Thank you, Keith. Thank you, Dirk, for this lively, very interesting, illuminating conversation. So this is the end of my questions. So now I'm going to move to the Q&As that we have from the audience. The first one is a very interesting one, and I think that I read something about this a couple of weeks ago, so this is particularly interesting to me. It's as follows. CLS system provides payment versus payment settlement for 18 of the world's most traded currencies and settles an average daily value of X. Given the G20 project dealing with enhancing cross-border payments, do you think that the DLT interconnection will address this issue? I don't know if the word should be interconnection, but the DLT cross-currency platform perhaps will address this issue. I think this is for Dirk.
Let's put it that way. The G20 cross-border roadmap initially had a number of building blocks, including one was about facilitating the adoption of PBP. Another one was, if I recall correctly, was also precisely around DLT, interoperability of DLT solution. I think this is what the BIS innovation hubs then subsequently explored. What we see in the G20 cross-border roadmap discussion, and we are part, for example, of an industry group under the umbrella of the Committee on Payments and Market Infrastructure, the CPMI, the so-called PI task force. You find this on the BIS website. We are looking into the topics, but the things we are discussing is not technology. The things we are discussing is how to make sure participants get access. What about money laundering and interoperability of solutions? Should we extend operating hours of current solutions? So DLT as such is not considered in this discussion as a solution, but maybe it can be an enabler. So there were some problems which need to be addressed, and potentially we can look at a DLT being an enabler. And then, of course, I think we only scratched the surface here in our discussion because we look at the infrastructure at DLT, but in our discussion, we sometimes mention wholesale CBDC, for example. We mention in general tokenization, but we mention stablecoins, tokenized deposits, and so on. So I think one needs to carefully look at what are the challenges and which payment rails and which assets could potentially help overcome the challenges we are facing.
That's great. Dirk, sorry, Keith, anything to add, or should I jump to
just to comment on the payment side of this? So obviously, BIS, as Dirk mentioned, one of the initiatives is obviously Project Agora and where that's going. Interesting perspective, I think, on that somebody made the other day is that it's essentially taking the corresponding banking network as it stands today and seeing how it can be reimagined using DLT and supporting, as you know, central bank money and commercial bank money in that kind of context. But essentially, we still end up with the 4 banks or however many banks involved in a corresponding banking network, as opposed to what DLT could provide with just a bank at either side or a participant at either side. So obviously, that has a role to play, I think, as far as cross-border payments are concerned, and how that will play out against what's happening with stablecoins at the moment.
Thank you, Keith. Next one is a very interesting one as well, which is, do you see market participants actually demanding instant settlement in FX market, or is it a more of a technology-driven narrative? And I would add another one, which is related. How would instant settlement affect smaller banks that might be already struggling with liquidity access? Who wants to go first?
Well, maybe I go with the first question. Are our clients demanding this? Well, what we see in our forward book, and also we have not only the settlement engine, we also have a netting service. We at least see that the same day settlement is on the rise. So it's not growing. I mean, it's not. We don't see a massive growth, but we see that in our services and what we offer, that there seems to be an increasing use case. But certainly it's a process. In the discussion around T+1, you always see the back office implications, what the banks, the market players would need to do in order to better service a T+1 environment. So these are all discussions to be held, and changes are needed in the back office space in particular. And this is a gradual thing to happen over the years, I guess. But yes, the use case seems to be growing, to answer the question.
And I think Keith is going to answer the part of would this instant settlement affect smaller banks more? Would you like to?
Yeah, well, I would have thought yes, in terms of the funding challenges, depending on the nature of the transactions as well. So I can imagine that would have a consequence. And I assume, therefore, in the market consultations and the POCs and the evaluation stakeholder discussions, as Dirk mentioned, the role that and the importance and the impact it has on smaller banks needs to be an important part of that, because not everybody is Citibank or JP Morgan.
That's true. The last one, before we finish, is how do you see the roles of incumbent FMIs evolving to provide desynchronizations and cross-ledger clearing and settlement services? How are those FMIs evolving to provide desynchronization and settlement services?
And that's a really interesting question. And I've been thinking about the new FMIs that might evolve. So we have examples here in the UK to some extent, for example, with Finality, that's obviously providing a central bank money-based settlement. So a new FMI, regulated, using omnibus accounts at the central bank, etc. So whether we'll see existing FMIs expanding their scope to support synchronization operator kind of functionalities, as we talked about before, or whether we'll see new FMIs that come into the space, maybe through the vehicle of bank consortia, for instance. I think that's a really interesting question. So, we know to some extent, where the regulatory and central bank expectations come in terms of what FMIs need to comply with, etc., and the expectations as far as that's concerned. But I think whether we'll see new FMIs changing the scope or, existing FMIs changing the scope and new FMIs coming into this market, I think is a really interesting question and a good one from a research point of view.
That's great, Keith. So that's it. Thank you, Dirk. Thank you, Keith, for joining us today. This is the end of the payment system broadcast number 26. In this slide, you have the resources that we have shared in the chat. And finally, coming up next in November, we're going to have a payment system broadcast number 27 with Roseman Labs, in which we're going to address a very interesting question, which is, can institutions share intelligence without exposing sensitive data? That's a very interesting topic, especially because you know that we work a lot on ways of preventing and detecting and monitoring and managing fraud and scams in payment systems. So that's a very important part of that. So once again, everyone, thank you everyone for being here. Keith and Dirk, thank you. I hope we are going to have you in the very soon once again. Thank you, everyone.
Thank you.
Have a nice
Thanks
day.
for having me.